care, especially if both people need care. Well, of course, the potential threat there is that if that isn't enough money, then they're going to have to decide which asset they want to liquidate next. Where would you get the next $150,000? Or if your care costs $500,000 or more, where would you get the money to pay for that? And would that potentially have significant negative consequences to your finances and your family? The answer is generally yes. So what we want to do is have a discussion with them about that particular asset that they just told us they would probably use to pay for care. What we can present to them is an alternative to reposition those dollars into a specifically designed life insurance policy that's going to help them pay for long-term care. Now, these are obviously just example numbers, but we might be able to take their $150,000 and move it into a life insurance policy that would provide $300,000 of long-term care benefits. Now, that's a good start. We've helped them in their quest to pay for long-term care. We've essentially doubled their money, but that still might not be enough, again, especially if both people need care. Well, the good news, and I'll explain this a little bit more as we go through the presentation, is we offer a very unique feature that can be added to all of our policies. We call it the lifetime rider. And what it's going to do is it's going to guarantee that instead of a maximum benefit of $300,000 in this policy, there's an unlimited amount of long-term care protection here, either for one person on a single policy or for both people on a joint policy. And as you're probably well aware, that's a feature that a lot of people like, but most companies don't offer it anymore. You may not even been aware that there was a company still offering lifetime benefits. We're actually the only company in the United States that currently offers lifetime long-term care benefits on a policy like this. We'll get more into it later. But what we've done here is we've essentially taken their $150,000 that they would have probably used to pay for care anyway, simply moved it into a different type of plan, and now guaranteed them an unlimited benefit. And what I normally say to the clients is, do you see how this can be helpful to you? And if they don't, what I say is this: if you didn't do this plan and you needed $500,000 or $600,000 to pay for care, or $1 million, worst case, you would have had to take that money out of your own portfolio and spend dollar for dollar $600,000 or $700,000 for long-term care. Under this proposal, we're taking the same $150,000, turning it into an unlimited bucket of money, and now the insurance company is going to pay for your long-term care no matter how long you need it. So here's an overview of our portfolio. We've got 5 or 6 different ways that we can accomplish that same thing. So at the end of the day, all of the products are very similar. Really, the only difference is how they're funded. And beyond that, what the underlying chassis is. So we have 3 products that are on a life insurance chassis. Those are called asset care. And 3 products that are on an annuity chassis. Today we're going to talk about one version of asset care. Because it's asset care, that means it's life insurance with long-term care. And the specific version we're going to talk about is Asset Care 3. And all that means, the number 3 just means it's funded with qualified money. So money from your client's 401k, 403b, or IRA. But before we get into the qualified money, I want to explain how you fund this product with cash, just so that we can build a foundation. So this is not yet qualified money. This is how you fund asset care with cash. Here's an example of a couple, 65 and 60. And by the way, we're the only company that offers these policies on a joint basis. That's actually a patent that we own. No other company can offer a life insurance-based contract to cover 2 people with one sum of money. And this is an example of a couple, 65 and 60, with $150,000 that they want to move into a plan like this. Now, of course, it doesn't have to be $150,000. This is just an example. And they don't have to be 65 and 60. They don't even have to be married. With our joint policies, we can cover any 2 people with an insurable interest on one another. So it could be a married couple, a boyfriend, girlfriend, not married, same-sex couple, brother, sister, mother, daughter, any 2 people with an insurable interest as long as they're no more than 25 years apart. In this case, they take $150,000. That buys them a life insurance policy with a death benefit of $300,000. If they need care, this life insurance policy is very unique. I like to say this is the only type of life insurance where you can be the beneficiary of your own death benefit. What does that mean? Well, normally with life insurance, you never benefit from it. Your children or your grandchildren do when you die. With this one, you can actually benefit from the death benefit. How does that work? If you need care, we'll allow them to take up to $6,000 a month from the death benefit to pay for care. So if one person needs care and they take $6,000 for long-term care, it's going to reduce the death benefit to $294. Now here's what's interesting. If both people need care at the same time, we'll allow each one to take up to $6,000 a month. So we'd actually pay out $12,000 in that calendar month. Just keep in mind that's going to deplete the death benefit twice as fast. So if one person needs care, it's going to last about 50 months, which is a little over 4 years. If both people need care, that death benefit's only going to last about 25 months, which is a little over 2 years. So that might be enough. I mean, if one person needed care, it probably would be 50 months. But if both people needed care, it probably wouldn't. The good news is we offer these optional riders. You don't have to add these riders, but most people do. Probably 80 to 90% of the policies we sell have one of these riders. The first one is called, I call it the double benefit rider because it doubles the benefits. Now, it doesn't double the death benefit, but it does double the long-term care benefit from $300,000 to $600,000. How does that work? Well, if one or both people spends through the death benefit and that $300,000 death benefit is gone, we would continue to pay the long-term care benefits up to an additional $300,000. Don't worry too much about that rider, and the reason why is most people don't add the double benefit rider. Most people add instead what's called the lifetime rider, and I talked a little bit about this on the prior slide. This is now purchasing an unlimited amount of extra coverage for as long as both people live. So here's how I generally explain this to people to make it simple. I say this, Mr. and Mrs. Client, if you were to enter into this program, you'd have access to 2 different buckets of money. Think of them like bank accounts. The first bucket has $300,000 in it. If you needed care, you could access that bucket up to $300,000. The second bucket has an unlimited amount of money in it, assuming we're talking about the lifetime rider. Both of you can access that bucket as well for as long as you live. So if you need care, you tap into the $300,000 bucket first, and if that runs out, the good news is you have an unlimited amount of money after that that you can tap into as well. The net effect of that, of course, is that both people have an unlimited amount of money to tap into for long-term care at a maximum rate of $6,000 a month. Now, why do we separate it like that into the 2 different buckets? Well, remember, the first bucket is the death benefit. So whatever you don't use for long-term care out of the $300,000, that goes to your beneficiaries when you die. Of course, there's a cost for these riders, but generally people are surprised, if not downright shocked, at how reasonably priced these riders are. I think if I didn't show the number there, some of you might have thought, gosh, probably $3,000, $4,000, $5,000 a year for that lifetime rider. The good news is it's a total premium of $1,300 in this case. That covers both people. So it's $1,300 total on a joint policy here. And that premium is contractually guaranteed to never increase. Now, they could pay it annually with a bill for $1,300, but what most people do is they pay it with a monthly deduction from their checking account, maybe $120 a month, $115 a month. I normally joke with people, but it's true. That's cheaper than your cell phone bill to get a guaranteed, unlimited lifetime benefit to add to this contract. This is called Asset Care One. Again, this is funded with cash. The minimum age is 40, the maximum age is 80. But the real reason for the webinar today that I wanted to discuss is this unique product called Asset Care 3. Now, what I hope you understand is it's essentially the same product as Asset Care One. There's not a lot of major differences when you fund the product with retirement money, but there are some, and I definitely want to point those out. This is the only product in the market, asset-based long-term care, that can be funded with a single premium of qualified money that does not create a taxable event for the full single premium. And let me explain what that means. If you think about some of the other products on the market, not ours, but some of the other companies, they don't allow you to fund it with qualified money. If you tried to fund it with qualified money, let's say $150,000, and you begged them to do it, they would probably let you, but they would make you well aware that if you do this, your client is going to get taxed on $150,000 next year on their 2016 taxes, and they're going to pay tax on that full amount as ordinary income. And I would imagine that almost no one agrees to do that, because I've never met a client that's willing to pay tax on $100,000 or $150,000 of income all at once. So what we did is we created a unique solution, a way to sort of get around that. Now, the first thing I want to say is you cannot fund insurance with qualified dollars without any taxes at all. So there are going to be taxes here, but the good news is instead of requiring your client to pay tax on all the money at once, we spread out the tax liability on them over a number of years. This hourglass is a good way to imagine how this product works. At the top of the hourglass is an annuity. At the bottom is a life insurance policy that provides LTC benefits. Why do we do it that way? Well, we do it that way because it allows us to minimize taxation on your client. If we take the money and put it into the annuity first, as you can see here, it's in the top of the hourglass, that is not a taxable event. So we can move money into this policy without creating an immediate taxable event. However, that wouldn't get any leverage. We couldn't turn $150,000 into more unless we did get it into insurance. So what we do is once a year, we take a small amount, in this case it's $10,000, out of the annuity, and we move it into the insurance at the bottom of the hourglass. In this case, we're going to take $10,000 a year, and here's how the policy is going to look at the end of the first year. We took $10,000 out of the annuity, so there's $140,000 in the top. And the bottom, we bought, the $10,000 bought a life insurance policy with a death benefit of $160,000. Again, the reason we do it this way is now your client simply receives a 1099 for $10,000 this year and not $150,000. Now, they will continue to receive 1099s of $10,000 for 20 years. But the question is pretty simple. Would you rather pay tax on $150,000 this year or pay tax on a small amount every year for 20 years? We found that everyone would rather choose option B, which is I'll pay tax a small amount every year for 20 years. At the end of the day, this allows us to do something very similar with the regular asset care policy, though, and that is get leverage. If you notice, we have $140,000 in the annuity, and we have $160,000 in the insurance. That means the total amount of money for long-term care is $300,000, essentially accomplishing the same thing. And then the riders are still there available, the double benefit rider or the lifetime. And again, most people are going to choose the lifetime rider. Now, this policy, you'll notice, is not available down to age 40 like the regular asset care. To do this policy, your clients have to be at least 59 and a half. The reason why is the distributions every year, which are taxable, would be subject to a penalty if your client was younger than 59 and a half. Now, some of you may be thinking, well, you know, I like this idea, but I'm wondering if my clients will be okay with paying tax every year. I can tell you that they certainly will be okay, and if they're not, there's some simple things that you might need to explain to them. You see, this is funded, again, with qualified money, which is pre-tax money, money that's never been taxed. At some point in time, your clients have to pay tax on this money. So when you explain to them that, listen, you're going to get a 1099 every year for $10,000, you have to pay tax on that. If they give you any pushback like, oh, I don't want to pay tax on this money, all you have to remind them is you have to pay tax on all of your qualified money at some point in time. In fact, at age 70, the government is going to force you to do so. That money's never been taxed. It will be taxed at some point. So by doing this, you're not creating an unnecessary tax burden on yourself. You may be doing a little bit sooner than you normally would have. But once again, if you wait, you're not saving any money. You're simply delaying the inevitable, and you have more money to pay tax on at a later date. Here's how the illustrations look for Asset Care 3. Here's for a couple, 65 and 60. They could be 70 and 60, 80 and 60, really any age. Doesn't quite matter. In this case, they've got $150,000. They dump it in, and it generates a death benefit of $300,000, like we talked about. And they can take $6,000 a month. Then we have the optional rider here for $1,300 a year, and this buys them lifetime benefits, both people, for the rest of their life. What I normally do on something like this is I give them an example, and I'll say, you know, let's assume both of you did need care. Of course, we hope you didn't. But if you did, this policy would pay out about $72,000 per year per person. If both of you needed care for 5 years, the total amount this policy would pay out is $720,000. $6,000 a month, $72,000 a year, 5 years apiece, $360,000 apiece in benefits, $720,000 total. Another nice thing about this policy is it offers something called a guaranteed return of premium. If you look at this column here where the arrow is, you'll notice that in the first year, if they decide to cancel the policy, they get all their money back. And same within year 2 and year 3 and year 4. In year 5, something kind of nice starts to happen. They start to build interest. In year 10, if they surrendered the contract, they would get a refund of $176,000. Now, you'll notice the death benefit on the policy actually moves a little bit. We promised them $300,000. Well, it actually is higher in the first few years of the contract and lower in the last few years. So you definitely want to point that out. The other thing you'd want to point out is taxation. What happens if your clients die without having paid tax on all the money? Well, here's how it works. The quote is always going to show a page here, which is this says this is the life insurance portion of the contract. This is the tax-free amount. So in year 1, if they died, their beneficiaries would get $300,000. Of that amount, $160,000 would be tax-free, and the rest would be taxable. You notice as time goes on, the tax-free amount goes up. And so essentially at the end of 20 years, the policy is entirely tax-free. Now, I know we've been over a lot here on the policy, the structure, and how it works, and there are certainly some moving parts. So I wanted to back up and sort of close on this point here. I think our clients really are concerned with the benefits of the contract and how does it benefit them, and not so much how it works. You know, I think of even traditional long-term care insurance. We sell it on the benefits. This is your monthly benefit. This is your inflation. This is your total lifetime maximum. This is your elimination period, et cetera. What we don't do is open up the contract and explain to them how it's actually priced and underwritten, et cetera. And I would encourage you to remember that with these policies as well. These policies are long-term care policies. And some people think, you know, this is so different than what I've been doing. I don't understand this. This is going to be so hard for me to explain. You absolutely should not think that way, because at the end of the day, this is long-term care insurance. It's designed to provide long-term care benefits. So when you sell this, don't get caught up on how it works. Your client's not concerned about that. Your client's concerned with what are the long-term care benefits and how's it going to protect my finances and my family if I need care. So essentially, this is the exact same sale that you would on a traditional policy. Here, I would talk about three things. I would talk about the long-term care benefits, and the long-term care benefit is pretty simple. It's $6,000 per month per person for as long as you live, with no lifetime maximum. That's pretty easy to explain. But you get to explain other things here which are kind of nice. The death benefit. In this case, if you never need care, if you don't use it, you lose it. I'm sorry, if you don't use it, you don't lose it. Your beneficiaries get $300,000 when you die. No matter how long you have this policy, that's going to be a lot more than you put in. So that's the advantage. And remember, it's not harder to sell something with a death benefit. It should be a little bit easier because if you don't use it, you don't lose it. And the third thing I would explain as a benefit is the cash surrender value. God forbid something happened and you had to cancel this contract, you can get all of your money back plus interest. If you focus on those, you'll have a lot of success in selling this contract. A couple words on underwriting before I wrap up. Most people think this is a little bit counterintuitive, but asset-based long-term care policies, including Asset Care and Asset Care 3, are slightly easier to qualify for than traditional long-term care insurance. The reason that may be counterintuitive is, how does a policy that has a death benefit and long-term care easier to qualify for than one that just has long-term care? Well, you're probably going to have to take my word for it on that, but we will consider people for asset care that wouldn't be eligible for traditional long-term care. And let me just give you a few examples. We will consider type 1 diabetics for this contract. And we will consider insulin-dependent diabetics. Now, I'm not saying that we will take everybody that has diabetes or is insulin-dependent diabetic, but it's certainly a possibility that we will if it's well managed. Chronic pain, controlled with narcotic pain medication, we will consider. People that have had strokes, 6 months after the episode, if it's a single episode, we'll look at those situations. We'll look at tobacco use in addition with diabetes, or tobacco use in addition to COPD, et cetera. So the best thing to do is, if you have a client that you think might be eligible for the policy, is to reach out to someone at AIM and maybe ask them. We can send you a pre-qualification form and help you determine whether your client will be eligible. Another thing that we're a little bit more lenient on is our build chart. For example, someone who's 6 foot tall, doesn't matter if it's a man or woman, we can go up to 342 pounds. 5'8", up to 305, just to give you an example. So, again, I'm not saying we'll take everyone regardless of how obese they are. There are still guidelines, but the guidelines are going to be a little bit more lenient than what you may have found. We're not going to take everyone, but there are certain people who've been declined for traditional long-term care insurance who could qualify for asset care. So the best thing to do is to run those situations past us. At this point, I'd like to open it up for questions if there are any.
Yeah, Evan, I'm going to go through and start unmuting people. I have a question. Maybe it's only because of my ignorance, but if you have somebody who did buy Asset Care 3, which potentially has the 20-year tax obligation, and they cancel it after 10 years.
Great question.
What does that do to the taxation requirement of the policy for those remaining 10 years?
Great question. So here's what's going to happen. In reality, if they were to surrender, let's say at this point in year 10, and we're going to guarantee them $176,000 back, there's still going to be approximately half of the money that they had invested they had not paid tax on yet. That money is still considered qualified money. And so when they surrendered and we promised them $176,000, part of that is going to be cash, and part of it is still going to be qualified money, and the best thing to do is for them to roll over the qualified portion into an IRA so that they're not taxed on it. So without giving you exact numbers, it could be $100,000 is still qualified. They would roll that into an IRA, and then the $76,000 would be cash, and they would be free to do whatever they wanted with that.
Okay, thank you.
Okay,
all the lines are unmuted, so does anybody else out there have a question of Evan today?
I have a question.
Fire away.
Okay, so they're going to get taxed every year when you take money out of their IRA.
Mm-hmm. And
yet, why are they getting taxed again when if they have a death benefit or they use a death benefit?
Okay, great question. Great question. Okay, so let's say in this case, they've passed away.
I'm sorry, I can't hear. There's some interference somewhere.
Yeah, some people. If you would please take me off. If you have it on a speakerphone, please mute your speakerphone. Or if you're not talking right now, if you can mute your mic, that would be also very nice as well.
Okay, so let's say the client passes away in year 1. Well, Uncle Sam, the government, has only received tax on $9,789. Keep in mind, they moved in $150,000 of qualified. So if you die, your beneficiaries are responsible for paying the taxes that you didn't pay while you were alive. If you only pay tax on $10,000, you haven't paid tax on $140,000.
Oh, right.
When you die, your beneficiaries will pay tax on $140,000.
Oh my gosh. Somebody's cooking or something.
Yeah, I know.
Yeah, but I think they're slamming pots around or something. So anyway, but like you said, after 20 years, there is no taxable event.
That's correct, because after 20 years,
okay.
they've paid tax on all the money.
Okay, thank you.
Mm-hmm.
Sure.
Great question.
Any other questions of anybody out there?
I have a question.
Fire away. Whoever had the question, please bring it up. Any other questions out there at all? Okay, listen, everybody.
Okay,
Evan,
hello?
Yes, hello.
I have one more question. Okay, so every year, in your example of 150,000, so every year 10,000 is taken out to pay for the 160,000 of insurance, correct?
Yes.
Okay, at what point does the insurance pay for 300,000?
If you look at this screen here, this screen shows the life insurance portion of the policy.
Okay,
In year 1, you have 160,000 insurance. This is actually an increasing death benefit policy.
Oh, so
in year 10,
after
you
you
have
use
11.
up the 150 and increases it to 200 or whatever.
That's correct. In this case, it increases to 287,000.
Oh, okay.
Mm-hmm. Good question.
Any other questions of Evan? Okay, if you want a copy of the PowerPoint, feel free to drop me an email with that request. My email address is dave.whelan, spelled W-H-E-L-A-N, @WHYAIM.com. Or if you have any additional questions that were not answered in today's session, pop me an email with those as well. Got a question here from Kim Glasgow. When do you do an annuity-based asset care versus life-based asset?
Great question. Great question. Yeah, so there's 2 reasons to use one of our annuity-based products, which we did not talk about today. There's, again, asset care is what we talked about today. These are life insurance. Annuity care is a different product. The 2 reasons to use annuity care are this. Number 1, if your client has an existing non-qualified annuity, one of the annuity cares is going to be the best product there because you can move a non-qualified annuity into annuity care without paying any taxes. Number 1, again, existing non-qualified annuity. Number 2, if your clients are not in good enough health to qualify for asset care. So I talked about the fact that asset care is slightly easier to qualify for than traditional long-term care insurance. Well, annuity care is even easier than that. So you may have someone out there who's really in what we would call average health. They're not eligible for traditional LTC. They're not even eligible for asset care. Oftentimes, we can offer them one of the annuity care products that we have. So those are the two times to use annuity care.
Is that something, Evan, that you automatically react to? Like if one of our people
Absolutely.
approaches OneAmerica about the potential for an asset care-based solution, and in previewing the case or underwriting, if they're really not going to be able to cut the mustard as far as asset care, will you propose back with the annuity care?
Absolutely, and I'll tell you, agents and clients love that. If you apply for asset care, go through underwriting, for some reason the client's not eligible, we will automatically let you know, with no additional underwriting, if the client would qualify for annuity care, and furthermore, which version of annuity care they may qualify for. The reason people love that is obviously the hardest thing in this business is to go back to a client with a decline. Well, in these cases, you get to go back to them with bad news and good news. Listen, that product that we thought we were, that you wanted, you can't get it. But the good news is here's an alternative that we can show you that you're already approved for. So yes, we will do that.
Okay, great. And just keep in mind, folks, that the qualified money is only available on the Asset Care 3 product with OneAmerica.
That's correct. Mm-hmm.
They will not accept qualified money on the annuity-based solution. So,
Dave, I may not have told you this, but we do have a brand new one that just came out a few months ago. It's called Indexed Annuity Care, and that one can use qualified money. It's not preferred, but the good news is we do now have an annuity-based solution that can take qualified money if they're applying for Asset Care 3 and they're not eligible. So I don't think I had explained that one to you yet, but the good news is we just came out with one.
And how do you spread the tax burden on that one? On the similar 20-year chassis, or is it a shorter year chassis on that one?
No, that one is actually, it's just a different contract. We should probably schedule a follow-up webinar on it. But because it's annuity-based and there's no leverage upon death, there actually is no taxation going forward on that product.
Okay, yeah, we will definitely pick that up. Any other questions out there? Okay, if not, Evan, awesome. Do appreciate you taking the time to educate us more on your solutions. Thank you, everybody, for taking the time to join us today. If you do want to copy the PowerPoint, give me a call. Number's on the screen. Be happy to get a copy of the PowerPoint over to you. Looking forward to working with everybody in this new, not necessarily new, been out there for a while, but this other option for a long-term care solution for your clients. But again, thanks everybody for joining us, and have a great day.
Thank you.